In this video, we're going to highlight 11 reasons owners are increasingly choosing employee stock ownership plans as a solution. It's a little longer at 8 minutes than our other videos, but it's designed to be educational so you get all the information you need to make a good decision. So it's interesting why owners are choosing ESOPs. A lot of owners, when they come to us, they've looked at the other solutions. They've looked at selling to a third party or private equity, and what they find is the Exit Planning Institute did this study where 75% of people that sold at a third party sale profoundly regretted it within a year. And they surveyed thousands and thousands of sellers, and that's what they found. And that's not surprising because 50 to 80%, depending on the statistics you read, of third-party sales fail. When you think about the ESOP, and we talked about the ESOP, there tends to be two categories of things that are sort of the features and benefits of ESOPs, and then there's the softer side of ESOPs. On the features and benefits side, with an ESOP, people are surprised to find you get, for most companies, you get a pretty comparable value with the ESOP to what you would get in a third-party sale. However, you don't get all of it up front. Okay, that's the good and the bad. The good is because you don't get all your money up front, you essentially get about what a bank would lend. The money you didn't get up front, you get about a 12% return on. So if you sold for 20 million, you end up getting 26 million. You sold for 30 million, you get close to 40 million, that kind of thing. So that's one, is that you end up with more money before tax. The other thing is you can sell to an ESOP tax-free. Now, the way you do that requires some explanation, but if you think about the 23 or 4 or 5% or California 33%, you got to pay the government when you sell, and for a lot of people it's even higher than that. Saving that is a pretty good benefit. When you do an ESOP, if you sell 100% to the ESOP, which is what most of our clients do, your company is typically going to be tax-free. You don't pay federal or state income tax. Well, that provides a lot of extra money to grow the company, to pay back the owner, to have benefits for the key people and the regular employees. And there's just a lot more money to go around. And that's why you rarely see management buyouts where you have to pay the tax and then pay the owner. In an ESOP, you're using pre-tax dollars. So that's another advantage. The next thing is you get to keep the culture intact, the legacy. And so what happens is whoever's running the company before the deal is typically running it afterwards, hiring and firing and buying equipment and opening offices, and strategy and all that kind of stuff doesn't change. And so people feel very comfortable with that because there's not a lot of dislocation. Everything's the same. The next thing is the employees do really well, obviously. You know, in America, the last statistic I saw was people retire with about $51,000. With ESOPs, that's hundreds of thousands of dollars to potentially over $1 million for your employees, and it meaningfully changes lives. Then the management team does even better. So not only is stock typically allocated based on what you make in an ESOP, so if you make 4 times as much money, you get 4 times as much stock, but we typically do a very robust management incentive plan where we set aside 10 to 15% of the value of the company for the key people. And that's hundreds of thousands to potentially millions of dollars for your key management team. And most sellers have made promises to their management team, and they want to really motivate that management team to drive value going forward so that the seller can get repaid, but also so the company can grow and prosper and everything works out well. So that's another reason people like ESOPs. The other thing is it's a much easier process. It takes about 4 months to do an ESOP. A third-party sale usually is more like 8 or 9 months in our experience, because we do those as well. It's way more confidential. No one's going to find out you're doing the sale unless you want to tell them. The closing costs typically are not paid by the seller. That's another advantage. And the process is just easier. There's a fair amount of due diligence like in any sale, but people aren't digging quite as deep as they do in a third-party sale. And you're not having management meetings in the office. People aren't retrading you, all that kind of stuff. And then the other thing is you get money at close, and then you have usually a fixed promise to pay plus interest. So you know you're going to get your money as long as obviously the company doesn't go under. In a third-party sale, the good news is you get more money up front. The bad news is the money you don't get up front usually is tied up in things called escrows and earnouts. And basically you have to perform going forward or you're not going to get that money. And there's statistics, a very high percentage of those end up in litigation. Whereas with the ESOP, it's a much friendlier and more sure that you're going to get your money. So those are all sort of features and benefits of why people like ESOPs, along with the fact that a lot of people own the real estate, and you have the choice of keeping the real estate and leasing it long term to the company so that everyone stays in that building and you have tenant, or you can sell the real estate to the ESOP, which has a lot of tax advantages because if you've been depreciating the real estate, at some point you have to recapture all that depreciation plus pay a gain, and that's a lot of tax, and you can avoid that. With an ESOP, you're still connected to the company. You can go to the trade shows, you go to work, you can keep working like you are, you can come back to a couple days a week, you can just be on the board. You pick it, and you pick how long you're connected to the company. So you don't have that issue because you're in control. And then when you decide that you no longer want to be involved with the company and you've received your money, from the sale, you can leave or just stay on the board or do whatever you want. And so that's a much better answer for a lot of people.